Meet Captain Whiskers, and he's got a serious problem. He's been working the same dead-end job at the fish processing plant for 3 years, earning a modest salary that barely covers his monthly expenses for premium tuna, catnip cafe visits, and the occasional splurge on fancy toy mice. Every week, Captain Whiskers manages to scrape together exactly $100 from his paycheck after covering rent on his cozy studio apartment and stocking up on his favorite treats. But here's the thing that's got his tail twitching with anxiety every night. He's got absolutely nothing saved for retirement, no emergency fund, and definitely no plan for achieving financial independence. Captain Whiskers sits by his favorite window perch, watching the birds flutter outside while contemplating his financial future. He's heard other cats at the Catnip Cafe bragging about their investment portfolios and retirement accounts, but honestly, the whole thing sounds as confusing as trying to catch a laser pointer dot. That weekly $100 feels insignificant, like trying to fill an ocean with a teaspoon. How could such a small amount possibly make any meaningful difference in building real wealth? The math just doesn't seem to add up in his fuzzy little head. But Captain Whiskers is about to discover something that will completely transform his understanding of money and wealth building. Something so powerful that it could turn his modest weekly savings into a substantial fortune over time. This isn't some get-rich-quick scheme involving cryptocurrency or day trading stocks. This is the proven, time-tested strategy that has created more millionaires than any other investment approach in history. And the best part? It requires absolutely zero special skills, no advanced financial knowledge, and no complicated timing of market movements. The secret weapon that Captain Whiskers is about to learn is called compound interest, and it's fundamentally different from the simple interest most cats think about when considering savings. Simple interest is straightforward. You earn a fixed percentage on your initial deposit, period. But compound interest is where the real magic happens. It's when you earn interest not only on your original money, but also on all the interest you've already accumulated. Think of it as your money making money on your money, creating an exponentially growing snowball effect that becomes more powerful with each passing year. Here's where most cats make their first critical mistake. They assume that investing $100 per week for a few years will simply result in having whatever they put in, plus a little extra interest on top. Captain Whiskers used to think the same way. He figured that saving $5,200 per year would mean having maybe $6,000 or $7,000 after a decade if he was lucky. This linear thinking completely ignores the exponential power of compound growth over extended periods. The mathematical formula behind compound interest reveals why this approach is so devastatingly effective. The formula is A equals P times 1 plus R divided by N, all raised to the power of N times T. Don't let the algebra scare you away, because the practical application is much simpler than the equation suggests. A represents your ending amount, P is your principal or starting amount, R is your annual interest rate. N is how often the interest compounds per year, and T is the total time in years. But Captain Whiskers doesn't need to become a mathematician to harness this power. He just needs to understand that regular weekly contributions create a consistent foundation for compound growth, where each dollar invested has more time to work and generate returns. The longer any investment compounds, the greater the growth becomes. This is why starting early, even with small amounts, is infinitely more powerful than waiting until you can invest larger sums later in life. Now, Captain Whiskers faces his first major decision: choosing the right vehicle for his weekly $100 investments. The conservative approach involves high-yield savings accounts, which currently offer interest rates around 4% to 5% annually. These accounts represent the safest option, with FDIC insurance protecting deposits and providing easy access to funds when needed. Varo Bank currently leads the pack with a 5.00% annual percentage yield on balances up to $5,000, while many other institutions offer rates in the 4.20% to 4.30% range. The advantage of high-yield savings accounts is obvious: safety and liquidity. Captain Whiskers would never lose his principal investment, and he could access his money whenever emergency expenses arise, whether that's unexpected veterinary bills or a sudden need to replace his favorite scratching post. However, this conservative approach requires significantly more patience to reach substantial wealth levels. With weekly contributions of $100 and a 4.20% interest rate compounded daily, Captain Whiskers would accumulate approximately $29,648 after 10 years, including $7,648 in interest earnings on $22,000 in total deposits. While this represents solid progress, Captain Whiskers realizes that this timeline won't get him to his goal of $100,000 as quickly as he'd hoped. The conservative approach works, but it demands either larger weekly contributions or a much longer time horizon to build substantial wealth. This is where many cats get discouraged and abandon their wealth building journey entirely, assuming that meaningful financial progress is impossible with their current income levels. However, Captain Whiskers is about to discover a more aggressive approach that has created extraordinary wealth for millions of ordinary investors over the past century. This strategy involves embracing calculated risk in exchange for potentially much higher returns. Instead of settling for the guaranteed but modest returns of savings accounts, he's considering entering the stock market through index fund investing. The stock market has delivered an average annual return of approximately 10% over the past century, with the S&P 500 index serving as the benchmark for American stock market performance. This represents a significant jump from the 4% to 5% available in savings accounts, but it comes with increased volatility and the possibility of losing money in any given year. Captain Whiskers' ears perk up with interest as he learns that this higher return rate could dramatically accelerate his journey to $100,000 and beyond. The numbers tell a compelling story that gets Captain Whiskers' whiskers twitching with excitement. With an average annual return of 10% from S&P 500 index fund investing, his weekly $100 contributions could potentially grow to over $1 million in approximately 32 years. But here's what really catches his attention. The total amount he would invest over that period is only $166,400. This means the remaining $833,600 would come entirely from compound growth and market returns. Even more impressive, those same weekly investments could balloon to $2.4 million after 40 years. Captain Whiskers pauses his bird, watching to let these numbers sink in. The difference between the conservative savings account approach and index fund investing becomes crystal clear when viewed through this long-term lens. While the savings account provides safety, the stock market historically delivers the exponential growth needed to build serious wealth from modest weekly contributions. The beauty of index fund investing lies in its elegant simplicity and automatic diversification. When Captain Whiskers buys shares of an S&P 500 index fund, he's instantly becoming a partial owner of approximately 500 of America's largest and most successful companies. One purchase gives him exposure to technology giants, healthcare innovators, financial institutions, consumer goods manufacturers, and every other major sector of the economy. It's like getting a perfectly balanced meal instead of betting everything on a single flavor of tuna. This diversification provides crucial protection against the failure of any individual company. If one particular stock crashes due to poor management or changing market conditions, the impact on Captain Whiskers' overall portfolio remains minimal because he owns hundreds of other companies through the index fund. Even if an entire sector struggles, his investment remains protected by exposure to all the other thriving industries within the index. Warren Buffett, one of history's most successful investors, strongly advocates this approach for ordinary investors like Captain Whiskers. Despite his legendary success in picking individual stocks, Buffett consistently recommends that average investors should put their money in low-cost index funds rather than trying to beat the market through stock selection. This endorsement from the Oracle of Omaha carries significant weight in the investment community. The cost structure of index funds makes them particularly attractive for weekly investors. Most quality index funds charge expense ratios between 0.03% and 0.20% annually, meaning Captain Whiskers might pay just $3 to $10 per year for every $10,000 invested. Some funds, like Fidelity's Zero Large Cap Index, charge no fees whatsoever. These rock-bottom costs ensure that nearly all of his investment returns stay in his pocket, rather than disappearing into fund management fees. Captain Whiskers decides to examine a real-world example using actual historical performance data. The Vanguard S&P 500 ETF produced a total return of 212% over the past decade, which translates to approximately 12% annually. At this pace, his weekly $100 investments would grow to $91,000 in 10 years, $374,000 in 20 years, and $1.2 million in 30 years. These numbers exceed even the historical 10% average, demonstrating how consistent investing can accelerate wealth building beyond typical expectations. But Captain Whiskers understands that not every cat can commit to $100 weekly. The strategy remains effective with smaller amounts, though the timeline extends accordingly. Weekly contributions of $50 would still build substantial wealth just over a longer period. The key insight is that consistency matters more than the specific amount. Regular investing, regardless of size, harnesses the power of dollar-cost averaging and compound growth. Dollar-cost averaging represents another significant advantage of weekly investing. Instead of trying to time the market by making large lump-sum investments when conditions seem perfect, Captain Whiskers would automatically buy more shares when prices are low and fewer shares when prices are high. This mechanical approach removes emotion from investment decisions and typically results in better long-term returns than attempting to predict short-term market movements. The S&P 500's historical resilience provides additional comfort for nervous first-time investors. The index has weathered numerous recessions, bear markets, wars, and financial crises throughout its history. In every single case, patient investors who held their positions eventually saw their portfolios recover and reach new highs. This track record doesn't guarantee future performance, but it demonstrates the index's remarkable ability to generate wealth over extended periods, despite temporary setbacks. Captain Whiskers realizes that volatility is simply the price of admission for higher long-term returns. Some years will deliver spectacular gains while others will produce losses. The S&P 500 soared 23% in 2024, but it has also experienced years with significant declines. The key is maintaining perspective and continuing regular contributions, regardless of short-term market fluctuations. Market timing attempts consistently fail because they require being right twice, when to sell and when to buy back in. Even professional fund managers with teams of analysts and sophisticated research tools struggle to consistently beat simple index fund performance after accounting for fees and taxes. Captain Whiskers finds comfort in knowing that his straightforward approach has historically outperformed the vast majority of actively managed investment strategies. The tax advantages of long-term index fund investing provide another compelling benefit. Investments held for more than 1 year qualify for favorable capital gains tax treatment, with rates significantly lower than ordinary income tax rates. Additionally, index funds generate minimal taxable distributions compared to actively managed funds because they trade securities less frequently. Captain Whiskers begins calculating different scenarios to understand his options better. If he can only manage $75 weekly, he'll still build impressive wealth, just over a slightly longer timeline. If unexpected bonuses or tax refunds allow occasional larger contributions, those extra amounts will compound alongside his regular investments and accelerate his progress toward financial independence. Independence. Captain Whiskers stretches his paws and settles into his favorite sunbeam, finally understanding that his weekly $100 isn't just pocket change. It's the foundation of a financial empire that could transform his entire life through the power of compound interest and consistent investing. Whether he chooses the safety of high-yield savings accounts or the growth potential of index funds, the key is starting now and staying consistent.